Well, it's going to be an eventful week. We've got a lot of data that could influence what happens with the U.S. Federal Reserve come September. There's already been a growing expectation that the Fed could cut interest rates. Then there's the broader dialogue around stocks being at all-time highs. A survey from Bank of America suggesting that some money managers are feeling a little uneasy about current valuations for U.S. equities. Eric Stern joining us now. He's Chief Investment Officer at Apollon Wealth Management. Eric, nice to have you with us. I guess let's start with the mood of the markets. It's been an impressive bull run. What's been your observation?
Well, thanks for having me. And I mean, earnings have supported this rally. True that it's a lot that has been concentrated in the megatechs with consumer services, information technology, but we're even seeing financials join this rally through really strong earnings. I mean, the S&P 500 right now is on track for the third consecutive quarter for double-digit earnings growth. And 90% of companies have reported, and 81% have reported earnings above estimates. So the earnings have supported this market rally. Yes, I do think it's getting a little frothy because we've seen economic activity, labor market, even consumer spending start to moderate. So I do think investors in the U.S. should continue to tilt towards the quality factor. Just last month alone, when we look at factor exposures, the high beta factor exposure was up 5.5%, and that represents more risky stocks. I think we're going to see some pullback there because as the economy slows down as a result of some of these aggressive rate hikes, that's when you want to lean into quality. So it's not a complete risk-on environment, in my opinion, right now.
I'm glad you brought all that up. There was a stat Bloomberg put together today noting that when you look at value versus growth within the S&P 500. So when you look at the S&P 500 value index, it's trading at its lowest level ever against the S&P 500 growth index, which obviously skews towards some of those Mag 7 stocks that have tended to dominate the S&P performance. I guess my question is, if value has lagged and has always had, attractive valuations, but has lagged, what would be the true catalyst for getting people more interested in some of those perhaps undervalued names?
Yeah, I think a few things. One, we came into this year expecting the market to round out and then for other sectors to potentially take the lead from the megatechs. But with all the tariff uncertainty, as well as there's a lot of uncertainty as the one big beautiful bill was being debated within Washington, D.C., that held back a lot of companies from capital expenditures and hiring plans. Now we have the one big beautiful bill behind us, so now companies can plan ahead. They know what's in that bill. As far as tariff negotiations, some agreements have been put in place. The White House administration still has some more work to do. And I think as that uncertainty anticipates, that could be the catalyst that we could see some of these more value-oriented sectors take off, especially if we do see rates, the Fed cutting rates later this year. I expect at least 2 rate cuts this year, but that's, of course, dependent upon inflation and labor market data coming in. But financials has been one of the star sectors this year, representing the value sector. It's one of 3 sectors where net profit margins have grown this quarter as it relates to last year. And I expect that rally within financials continue because we see deregulation policies on the horizon and potentially more activity in the IPO markets that will benefit the big banks' profits.
It's interesting. The S&P Financials subgroup has had a reasonable performance this year. In Canada, we've seen financials as a group with slightly better performance on the TSX. One of the other big themes of the year was going beyond U.S. borders. And I'm not just talking about the Canadian stock market. I'm talking about how investors were giving Europe a second look for the first time in a long time. And I guess I do wonder how you're going to be, how close you're going to be monitoring international equity flows heading into the fall.
Oh, absolutely. I'm a huge advocate for always having some international exposure in our portfolios. Clearly, coming into this year, there's a huge gap from a valuation perspective if you like to price to earnings ratios. And when you have valuations trading at that much of a discount, all you need is a few things to go right to really see an aggressive rally. And that's what we've seen across almost all international markets this year. And I do think that the U.S. market is starting to bounce back right now. The dollar has depreciated, and that's actually helping U.S. companies that have businesses overseas. But I remain a strong advocate for international exposure because as the world backpedals from globalization, I think we're seeing more nationalistic policies. I think that's going to lower the correlation between international markets or international equities and U.S. equities. And that's just going to help the diversification of client portfolios.
All right, Eric, thanks very much for your perspective. Eric Sterner joining us, Chief Investment Officer at Apollon.